Sunil Subramaniam, good afternoon.
Hi, good afternoon.
For a bull like you also, I think now there are concerns which you need to really be cognizant of. Soap and shampoos are not selling. GDP is below 7%. Government capex is low and FIs are selling.
Well, you got to look at it as how much of it is short term and how much of it is sustainable in terms of those 4 pointers. I don't think any of them is a sustainable thing. We could. So first of all, let's talk about soaps and shampoos, right? What's the forces at play here? There are two things, right? One is that while India's per capita GDP has expanded to 2,800 levels, you're seeing that the K shape, which is true of the consumption also because of this, is that the rich are getting richer and the poor are remaining where they are, right? So it's a very polarized economic growth that's happening, whatever is happening, right? That's number one. Number two is the fact is that so at the bottom of the pyramid, incomes are not growing at the same pace as the top. The second aspect is that inflation. For some reason, despite a good monsoon, we are having food prices being very high. It's a little bit of a puzzle. It's probably because the rain fell in the wrong places at the wrong time. Okay. So, but still, there is optimism that with the kharif crop and the rabi sowing being good, inflation would head down because at the bottom of the pyramid, inflation eats up. See, half of a bottom of the pyramid person's income goes on consumer staples, right? Those are very critical to him. So if your income there is stabilizing and inflation is going up, then your consumer surplus is narrowing, then you will postpone, you'll make that bar of soap stretch that much longer, you'll make that shampoo last that much longer. That's one. The second aspect is the two elections back to back. That is the big one, the parliamentary election, and this meant that the government took its eyes off the capital, which you also mentioned. But as a result of which, the government is a huge trickle down effect in the economy. For every road or instruction that is built, there are people who lift the sand, people who lift the cement. So all of those trickle down incomes, if they have come down, which means it's further pressure there, right? So that's the context to the consumption story. Now you mentioned that private capital is not picking up. Now it is the bottom of the pyramid consumption that has to pick up for capex to pick up because high and K-shaped recovery in the consumption means that less number of units are being sold of the big cars and the big houses. But the mass production of the other housing or the two-wheelers and the entry-level cars, that's not happening. But capacity utilization comes from volumes, not from value. So unless this bottom of the pyramid consumption gets solved, then the capacity utilization shoot up, private sector capex will only then step in. It's a natural process and you have to be patient to wait through it. So what are the steps there? First is inflation, hopefully with the monsoon effect and the rabi effect should come down. Government should start spending because see, they're approaching the budget season. They have to make plans for next year. Now, if they're going to undershoot their capex estimates for this year, they can't go with a high number. So I expect a last minute pump up through the last quarter of government spending, which will automatically have its trickle down effect in the economy. So other thing is that we talk about the past data. The earnings already gave you a sense of the GDP coming through, right? The earnings season was so bad that the GDP number shouldn't have been a surprise. Now, what the RBI governor is saying, yes, he had to kind of roll back his 7.2% full year to 6.6. But that being said, he's still sticking from a 5.4 of last quarter to 6.8. So that's a 1.4% uptick in GDP that the governor expects, probably on the back of the government picking up the capex and the festival season numbers playing out. So I see no reason for pessimism that come January 10th onwards, when the earnings seasons come, because the market has got pessimistic with the GDP data and the earnings, they're also lowballing their estimates. I'm sure that the earnings season, as it pans out from 10th onwards, will show a better than consensus numbers and hence an upward revision in things, which should be a good for the market because the GDP number only will come by end February. The economic survey coming just before the budget might give a clue to that, right? Now I'll come to the final point. So government capex will continue to pick up speed. Private capex will still take time, right? But the final point about FIS selling. Now FIS selling for what reason? I think that first was a few months ago the China stimulus and all that. Today we hear again about some China stimulus. But the more important thing is China is not the big thing. The big thing is the dollar strength. And if the US economy is recovering on a risk-free basis, I make 4% on my debt and I probably make 10, 12% on a risk-free basis on the equity market in the US. So there's just a reversal to that. And finally, we are in that stage, Nikunj, of that period of the year when hedge fund managers have to book profits. So they started early October, November itself. You're seeing now from December, first 2 weeks, there has been a uptick in the FII. So bulk of the profit booking is done. That being said, I don't think that they are going to come back in a rush now. Most of them are probably planning their holidays. They're off on their Christmas, New Year vacations. Come back first week of January and then reallocate. So even then, they will wait for the earnings season to spell out what I'm saying, and then they will come back. And then the budget again will be a cause for euphoria, right? Because the government will again lay down reforms. They got confidence now with Haryana and Maharashtra turning over whatever pessimism there was about the government's continuance, right? So the confident government will continue on its path of reforms. And what you said just now said, somebody said about the fact they could give tax relief to boost consumption. I think all of those are positives in the budget season. So I expect that mid-January onwards, right through the budget season, the FIS will come back. And domestic flows, you would have seen the data today. They continue to be strong. SIP book continues to be at 25,000 crores. The only thing is domestic flows are largely tilted towards the mid and small cap, whereas the FIs are largely in the large and mid cap. So you're going to see a consolidating market. Fund managers have the firepower to buy at the lower end of the cap curve. FIs are naturally selling at the higher end. So this tussle of you versus me is have a making point. So you will see some corrections in the large caps, and then they will, if there is a good large cap to buy, a fund manager may sell a good small cap which has run up a lot. So I think that we are in for a period of consolidation for another month. Just be patient. And as he said, as a bull, I see that this is the time to pick good quality over momentum, pick good quality over value as they've been doing, and good quality stocks, buy them on dips, sustained, but big allocations probably mid-January onwards is where I would expect to happen.
Well explained, Sunil, as far as the entire facets of investments is concerned there. So mid-January is when you need to start deploying in a better way, just ahead of the budget. That's the take coming in for now. Time now to head into a very short break. Don't go anywhere. When we come back, we'll discuss a lot more stocks and charts with Kunal, Naresh and Sunil. Welcome back. Well, for the markets, it's looking all right in the sense that we have been just fairly range bound. It's Raymond which is doing well in the trading session. JBM Auto is doing quite well. So let me take it across to Kunal to get a better understanding on these two charts. Raymond as well as JBM Auto, Kunal?
Yeah, Raymond is looking attractive. In fact, after today's price up move, this 10% plus kind of a move for Raymond, the stock is confirming a 2-month swing breakout. So previously the stock was taking a lot of resistance at the 1700, 1720 range as a resistance twice in the last 2 months. The stock managed to come back to this breakout point, but it failed to do it. Today the stock has confirmed the breakout on the back of a significantly higher volume. So today's volume, for example, for Raymond is around 90-95 lakhs on the NSE, which is one of the highest volumes the stock has seen over the last many months. So that itself indicates that the price is now the prices are now getting back into a resurrective trend. This trend, I think, should take the stock back to that 2000 plus mark over the very near term. So it looks attractive. JBM Auto, even that stock is confirming a breakout of a swing resistance above 1650 levels. So again, look out for targets in the range of at least 1800 to 1850 over the very near term.
Okay, so that's the target coming in on JBM Auto as well as the chart of Raymond looking good. Separately, Greaves Cotton is doing quite well in the trading session, and ditto can be said for Nippon Life AMC as well. Naresh, on the charts?
So both these names have broken out and have done really well. So for now, one should wait for a dip. If you look at, say, Greaves Cotton, the previous all-time high is closer to 255, 260. So that it's getting very close to those resistance levels. So should take a pause here. Would wait for a dip in this case, not buy at current levels.
Don't buy at current levels, wait for a bit of a correction. But, Sunil, I want your take regarding some of the metal names. But before that, let me play a soundbite of what Mr. Anil Agarwal of Vedanta Group had to say, because that demerger is impending and that's something that the street is watching out. He talked about how demerger is going to be a value unlocking kind of scenario for the shareholders. So that's something to watch out for. And he did talk about the timeline of, I think, Q1 FY26, if I have it right, or Q1, FY26, when that will actually take place. Here out that soundbite, and then we'll discuss that further.
each shareholder of Vedanta one share will be 6 share. And all 6 companies are doing extremely well. We have seen some places that they all are doing extremely well, and I am the kind of business what we have in all these companies. The merger will take place, should happen in early first quarter of next year. And each companies are doing extremely well, will have a very good dividend policy, share price will do very well according to me. So I have no doubt that for me I'm very conscious that my shareholder, I have a responsibility towards my shareholder and I fulfill that responsibility.
Okay, so responsibility towards shareholders to unlock value. I will come to you, Sunil, in just a bit. But before that, let me take it across to Anurag. He's been standing by to talk to us about the non-life insurance data. Anurag, some of these non-life insurance companies, the likes of Star Health, etc., are coming under pressure right now. Is the data a little more tepid than what the trend has been so far?
So this is the first time official data that the GI Council has released with the exclusion of long-term premium. So from 1st of October, IRDA has changed the rule where insurers cannot show the long-term premium in the books. So the first caveat is that this cannot be completely compared with the last year November data, but data is showing that there is in a non-life company there is some sort of pressure is there after the exclusion of long-term premium. So if we talk about the overall industry, after the long-term adjustment, the industry has shown a growth of 2.45% only, and the premium is in month of November. Standalone health insurance companies are showing a growth of 10%, and Star Health growth is of 7%. Niva Bupa is showing a growth of 14.5%. So first time after the listing of Niva Bupa, the data we are discussing Niva Bupa also, because we discuss majorly the listed companies data. The market leader New India after the adjustment is showing a good growth of 6%. And ICICI Lombard, there is a negative growth after the adjustment, same for the Go Digit also. And if we talk about the 8 months figure, then Lombard growth is around 12%. New India growth is 3%. Star Health growth is 14%, and Niva Bupa again showing a growth of 26%. So it's a 8-month figure with a caveat of long-term adjustment. I will also share the market share. So ICICI Lombard is gaining market share, reaching towards the 10% market share. Star Health is at a market share of 5%. Go Digit again 2.85%, and Niva Bupa is again gaining the market share. So after the new IRDA rules effective from the 1st of October, this is the first official data released by the GI Council, which has a caveat saying that companies has reported the long-term data, companies has excluded the long-term data, and which is showing an overall growth of 2.5% for non-life insurance industry.
Anurag, for clarifying that. So the data is not exactly like-to-like comparable, but that's the latest information that we have at this point of time. Sunil, let me come to you and talk about the insurance companies, because that was one sector that hadn't done well. There were these overhangs which were there, but on the other hand, you have the penetration which is low, and if you just go by plain simple logic, this is an area which is expected to expand further, and that fillip of GST was also expected to come in through. What's your sense on the insurance stocks at this point of time?
I agree with your thing that the penetration story means that for all the minor bottlenecks which will keep coming up, I don't know, in terms of taxation and all of that. But I think overall it's a very good place to place your bets on, because if you recall my earlier answer, I was talking about the per capita income going up in the country to 2,800. And all of this will have a spillover on the savings pack entirely. And insurance is a big part. The awareness post-COVID has increased on health insurance and life insurance. So both of these, I expect that the penetration should rapidly move with the private sector taking the lead there. So I remain that the shorter term things, I would still say a buy on dips. I think sticking with good quality insurance companies will pay off in the medium term.
In the medium term, it's still a good, bet for at this point of time. Sunil, on that note, we'll let you go. Thanks so much for making time for us. Time for a quick break. But as we do that, here are the conversation my colleague Anurag had with Mr. Anand Rathi on the sidelines of the Rising Rajasthan Summit.